Welcome to your weekly wrap-up. I'm Elaine Stenson. The Bank of England's Monetary Policy Committee voted unanimously against any policy change in March and chose to keep rates at their historic lows of 0.5%, with asset purchases also unchanged. All committee members agreed that none of forward guidance's knockout conditions had been breached, and with unemployment remaining about the 7% threshold, forward guidance remains in place. Rob Carnell, Chief International Economist from ING in London, joins me on the line now for a look at the week in review. Rob, there were no surprises from the Bank of England this week. Is the UK still on track to becoming the fastest growing G7 economy?
Yes, I think it is. The high frequency data that you look at on the UK is very strong. The purchasing manager indices are at extremely robust levels, consistent with growth well in excess of 3%. The consensus expectations for UK GDP growth have been growing rapidly. The Bank of England itself seems to think that the UK will grow at somewhere between 3.3 and 3.5% both this year and next year, and it really is only the government at this stage perhaps playing a little bit carefully with their forecast. They don't want to get too ahead of themselves, who seem to think it'll be sub 3%. So relative to the US, relative to Canada, relative to Japan, this is all looking, certainly relative to the Eurozone, this is looking extremely strong.
OK, and across the Atlantic, we saw the FOMC meeting seemed to spook markets slightly. Rob, were you expecting that? And how do you think that Janet Yellen did in her first meeting as chair?
OK, there were two elements that spooked markets with respect to the recent FOMC meeting. The first of these was this so-called dot diagram, which showed that more FOMC members were expecting there to be more rate hikes over the next number of years. So by the end of 2015, they were expecting 1%, as previously they were looking for 0.75%, and by the end of 2016, they were looking for 2.25% interest rates, as opposed to 1.75%. So a big increase there, and I think that was one of the factors that spooked markets. And the other was in response to a question on how long after the end of QE might we expect to wait before the Fed actually started hiking rates. I think most people around the world imagined that we'd have to wait for around a year, and Janet Yellen told us 6 months or something like that. She was a little bit woolly about her response. And there was almost an audible gasp of disbelief around the world in response to that. So we do have a number of Fed speakers over the next couple of days. So we wait to see whether or not that was her intention, in which case, she did what she was told, what she was expected to do, which was to tell us what they were doing, or whether or not that was a slip of the tongue, in which case she didn't do such quite a good job. And the Fed speakers will no doubt try and push us in the right direction over the next day or so.
And of course, the situation with Russia and Crimea has been dominating the headlines this week. Rob, do you think that Western sanctions on Russia are a good idea, or could they have a rebound effect?
Well, whether they're a good idea or not, I think is not for me to say. But in terms of a rebound effect, there's scope for this to happen. It's understandable that the United States and the European Union, given their stance on Crimea, the way that they've interpreted the events there, have felt it necessary to impose sanctions. At this stage, they're mainly on sort of financial access and travel for certain individuals that they feel in what they see as an illegal annexation of that region. For their part, Russia has retaliated with sanctions or similar sanctions on, at least to my knowledge, certain US officials. Harry Reid dare say that there'll be some EU people appearing on lists before too long. Now, we can do this. They can play this game all day long, and then in the end, I think not really too many people care. However, if this thing does have the scope to escalate, and should these sanctions just start to snowball before too long, we're talking about proper economic sanctions and so forth, then that's just genuinely a lose-lose situation for everybody, I think, in the end of the day. So, I think the hope within the financial market community is that, tensions simmer down a little bit.
OK, Rob, and finally, what will you be looking ahead to next week on the economic calendar?
There's not a huge amount coming. Actually, the next couple of weeks we've got a few things. Market has been dominating decisions in terms of financial markets. So that's going to be one of the major events, I think, over the next couple of weeks that's going to be worth looking out for. If we get another reasonable number and we start to see the United States returning to snowy weather affected data, and we might get an idea that actually it's growing okay and people feel a little bit happier. The other thing is just keeping an eye on the China data. We haven't got a huge amount on that, but will give us some idea on whether we need to worry about China or not, and of course that will have implications for financial markets as well.
OK, Rob, many thanks for joining me on the line today. And that's your weekly wrap-up for this week, but we will, of course, be back on Monday for a look at the week ahead. Bye for now.